Hello and welcome to another episode of Property Ponderings, the podcast where we dig deep into the world of property buying and renovating, giving you property advice to ponder. I'm Craig Nicol from Nicol Buyer Advisory here in Melbourne, Australia, and I'm here to help you turn your property dreams into reality. With over 15 years of property experience spanning everything from town planning and sales to auctioneering, property investing and buyers advocacy, I've gained insights into every corner of the property world. Today's episode tackles a big question that every property investor will face at some point. Is holding property forever always the right choice? By the end of our chat, we'll have a clear understanding of the long-term power of holding property, the hidden costs of selling, and when it might actually make sense to part ways with an asset. So let's dive in and explore whether holding on forever is really the golden rule for property investing. Okay, let's get into it. So let's start with why holding property for the long term is often seen as a winning strategy. History and research show that well-selected real estate has a remarkable ability to grow in value over time. In Australia, the capital city property prices have grown by an average of 6 to 8% per annum over the past 30 years. This is partly driven by population growth, limited supply in desirable locations, and inflation. Take Melbourne as an example. According to CoreLogic data, the median house price in 1993 was just over $125,000. Fast forward 30 years and that figure is now pushing past $900,000. For those who held property during that time, the rewards have been staggering. Beyond capital growth, holding property enables you to firstly leverage compounding growth. So by holding an appreciating asset, you allow the power of compound growth to magnify your wealth over decades. Secondly, it allows you to avoid transaction costs. Selling property incurs significant expenses like stamp duty on new purchases, agent fees, capital gains tax, and more. These can easily consume 10 to 15% of the property's value. And the last thing to look at for holding property beyond the capital growth is generating passive income. Over time, rents increase while loan repayments stay relatively stable. This turns your property into a cash flow positive investment, providing financial security. And this is one of many people's long-term goals. But let's be real, holding forever is not a one-size-fits-all strategy. Not all properties are created equal, and some investments simply don't perform as expected or aren't necessarily a part of the long-term plan. Here are a few reasons why it might make sense to sell. Firstly, if your property is underperforming. If your property is in a location or condition that limits its growth potential, holding on to it might actually hold you back financially. Key indicators of a poor performance include below average capital growth compared to the market, negative cash flow with no signs of turning around, high vacancy rates or declining rental demand. As Margaret Lomas suggests, property investments must work hard for you by delivering growth or income. If yours isn't, it could be an idea to relocate your capital to a better performing asset. The second reason why it might make sense to sell is to take profit off the table. Selling a high-performing property to lock in significant gains can also make sense. This might be especially relevant if you're approaching retirement or want to reduce financial stress by paying down debt. Ray Dalio's principles remind us of the importance of balancing risk and reward. In this context, deleveraging and crystallizing profits can sometimes outweigh the benefits of holding. The third reason why selling might make sense is changing life circumstances. Life happens. You might need to sell to fund a business, relocate for work, or handle a major expense. Flexibility is the key in these situations. And the fourth and final reason why selling might make sense is market cycles and opportunity cost. Selling in a booming market and reinvesting in undervalued opportunities elsewhere could yield better returns. Timing the market is of course risky, but sometimes necessary to optimize your portfolio. Buyer beware to undertake that one. Now let's get clear about the hidden costs of selling. While selling can be the right choice in some scenarios, it's critical to understand the financial impact. Here's a quick breakdown. Capital gains tax. Up to 45% of your gain could go to the ATO if the property is not your primary residence. Of course, get tax advice from your accountant before making a major sale that could cause you major issues in capital gains tax. The second thing is stamp duty costs on the new purchase. This is a massive upfront cost if you plan to reinvest in property. And I think this is one of the biggest reasons why people don't turn over property more often. You may have heard in recent years that they're talking, or different governments are talking about removing stamp duty. And this would create a market where flipping and turning properties over would occur a lot more often, which some people may see as a negative, but it could be a positive if it does allow more people to enter the market and also turn their properties over if it makes sense to, when they don't want them anymore, but they're scared of the stamp duty implications of buying a new property and just making it generally not worth doing that. Whereas if that property is sold, it could free up that property for someone else to live in. So look, it's a complicated issue, but it has been spoken about. And that stamp duty is a major cost of selling and then buying another property. The next main cost is agent fees and marketing. You can expect to pay 2 to 3% of the property's value in agent commissions. And then in regards to marketing, it of course depends on the value of your property. But really, to get up on the main internet portals these days, you're already looking at $5,000 to just do that. And then you've got to add on top of that all the brochures and the photos and everything. So you're really looking between $5,000 and $15,000 for most people. The other hidden cost of selling is lost opportunity costs. You're no longer benefiting from the compound growth on that asset. And that's a really big one. And I think that's the big one about regret as well. If someone is to sell a really good performing property, how are they going to feel in a year, 2 years, 5 years when the property continues to grow in value? So these costs mean selling should be carefully considered, as the financial hit can significantly erode your profits. So when do you sell and when do you hold? So let's sum up a few of the scenarios. Normally you would hold if your property is in a high demand, high growth location, you're in an accumulation phase and can leverage equity for future investments, and you're generating solid rental return and benefiting from tax advantages like depreciation. You may choose to sell if the property is consistently underperforming with little chance of improvement, but be careful of selling a property that you believe is underperforming when it could just be about to turn. I know there are a lot of people holding properties in Melbourne and it has been an underperformer compared to the rest of the country. And so you really have to assess whether your property does have a chance of improving and growing, or whether it's just simply right now the market isn't performing for you, but it will be. And I think for a lot of people holding good assets in Melbourne, the large majority of them aren't underperforming in general over the longer term, but right now it can feel that way, but that growth could be just around the corner. The other reason why people may choose to sell is if you need to deleverage or fund other priorities. So this is a really big one. If you are over leveraged, there does come a point where the stress is too much maybe, or the situation just makes it appropriate for you to deleverage your portfolio, such as people that are retiring and wanting to retire debt. And the last reason is just if there's an opportunity cost that completely outweighs just holding on to the property, then you may sell as well. This could be a situation where you get offered a crazy price in a really hot market. You see this happen with development style properties. You might have a big block and you get crazy offers from people knocking on your doors through that period. You may take that money and then just reinvest into the market and reset in another position because that opportunity is just too good to be true. So there is that opportunity for the lucky few that have properties in those situations. So at the end of the day, the decision to hold or sell comes down to the strategy, performance, and your personal goals. As Morgan Housel says in The Psychology of Money, the trick is to stop chasing what others are doing and find the game you're playing. So look at what you're doing, what you're wanting to achieve, and then make decisions from that point of view and not what others are doing. Holding property forever, though, can be powerful, but it's not always the best move. Take a critical look at your portfolio, run the numbers, and don't be afraid to adjust your approach if circumstances demand it. Alright, that ends another episode of Property Ponderings. I hope this has given you a few small tips to ponder. If you'd like to discuss anything further from this episode, or you want some tailored advice for buying or renovating, please feel free to contact me. We're also keen to hear your questions for future episodes, so send your messages to craig@nickelbaradvisory.com.au or 0400 122 081. Thanks for tuning in, and I'll chat again with you soon. Information provided in this podcast is for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique and should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult with a qualified expert who can address your specific needs and circumstances.